Dhiraj Agarwal is with us, Managing Director at Ambit Investment Managers. Dhiraj, good morning. Good to have you with us here. Do you want to sort of weigh in on that? I don't know if you had a leaning one way or the other. Longer trading hours, same sort of no change. And of course, now we know that it's not going to move forward. Any thoughts at all?
I would prefer the trading hours not to be extended. I think it's long enough at this point of time. Market participants are working hard enough. Nobody wants to work 24/7. So I think we're doing okay. I mean, I don't think we actually require longer trading hours, but that's my personal view.
Yeah. Just a quick word on the market, Dhiraj. And especially sort of tying this in with the elections which are on. What's your sense? I mean, is it at the margin a bit of a worry, or not really? Or let me ask you this way: is it becoming a bit of a worry? Because no one was worried. Opinion polls, etc., everything was pretty clear cut, a thumping victory.
I think elections may be used as a catalyst or a reason for a market correction if it happens, but the actual reason is not really the elections. The actual reason lies somewhere else. And something which I've been talking about on your show in the past as well, that despite the fact that the earnings growth for Nifty or earnings growth for our markets has been robust, sales growth has been weak, and it's not showing any signs of revival, which actually puts FY25 earnings at risk. There's an additional risk, two additional risks right now. Looks like the Fed rate cut hopes is very much postponed till end of the year, at least, if not to 2025. And there are very strong signs of China revival. So at the margin, China can pull some FPI inflows away from India. So there are other risks in the market which are more real. Election is, I mean, everybody will probably just use election as an excuse if there is a correction.
Dhiraj, hi, good morning and thanks for joining in. Today, the place to be in really is the FMCG space. So Marico is up almost 9%. Just pull up that stock. Big volumes coming in. I don't know the last time I saw Marico surging 9%, right? I mean, it has been a big underperformer of late. Dabur is up about 4% odd. And we were just talking about how so many of these companies are now large consumer giants, whether it's Nestle, Dabur, even, global giants like Coca-Cola have lined up big investments in India to step up their capacity in the premiumization space. So what do you think would be the big beneficiaries of this, or who would be the big beneficiaries of this? And which are the stocks where there is still valuation upside?
In general, I think FMCG suffers at this point of time from slower demand and the valuations, although they have come off in the last 2 years, that I still don't find them cheap. And with respect to single-day market moves like the ones we are seeing today, this has become a commonplace in our markets that every single news bite, every single result or guidance by the management, and even broker upgrades and downgrades result in at least a high single-digit price moves, even in large cap names. So 8 to 10% kind of moves have become very commonplace. Yesterday, Titan was down 7.5%. Not very usual for a company of Titan's size and pedigree. Britannia was up 9% at the open yesterday, closed slightly lesser than that. So it's become commonplace. I mean, these movements just show heightened activity in the market. Remember, we are trading 1.3 lakh crores cash market trading NSE plus BSE every day. So I wouldn't read too much into it.
All right. Hi, Dhiraj. Good morning. Good to see you, Ben. Dhiraj, I wanted to ask you about two stocks that have been actually outperformers, if you look at it, say, in the last 5 years or so, Trent and Bajaj Finance. The problem is when you're at the top in the class, then the teacher wants you to give even better results, which sometimes it's not possible. Both these two, they came out with their set of numbers as well. Bajaj pulled back a little bit. Trend people still seem to be interested in. What's your view on both these two names? Is the best already in the price, or is there more to come?
So the trend is clearly benefiting from the fact that it's the highest growth consumer company across discretionary and non-discretionary space. I mean, they've really executed well. We can keep arguing about the valuations on that company at this point, but the growth is such an outlier. And execution, even on execution, they've been such an outlier that they can continue to enjoy premium valuations for some more time to come. So till such times that they are benefiting, I would say to some extent, from the TINA factor, the scarcity value, which a number of so-called already stocks benefited from between 2013 to 20, because that was the only investable space available. So within the entire consumer space, there's just a handful of companies which actually stand out with very, very high growth. Bajaj Finance, on the other hand, their differential in terms of their execution and growth with respect to many other parts of the industry has been coming off. And while Bajaj Finance has done beautifully over the last 10 odd years, last 2 to 3 years they've actually gone sideways and broadly in a range, and hence to some extent I would say they've started to underperform, as a result of which the valuation's automatically coming down. So could consolidate for a while more is my view.
Okay. The other space that, by the way, CG Power is the one that's really surging now, 5.5% higher. This after the positive commentary that we got from the management, right, just a while back. In case you missed it, they said that they are seeing a very strong growth in their power and railway business. And they also spoke about how 6,300 crores is the current order book that they have. And the turnover can go up by an additional 1,800 crores by FY27 once their new facilities come on stream. So it's plenty that's happening here in CG Power, up almost 5% right now. Dhiraj, any thoughts on some of these names? I mean, there's big growth that we're seeing currently in, whether it's the railways business, power business. Do you think it makes sense to put more money to work here?
I think this theme is broadly working. So I have no comments on the specific name that you mentioned at this point of time, but this theme has been largely working. So this is the focus of the current government and the current policy to keep on encouraging investments within infrastructure, whether it's roads, power, railways, airports, etc. And every market trend is characterized by one theme which becomes a dominant theme in that particular market space for a while. So this whole capex and infrastructure theme, I think, will continue if the current government comes back, for which there is a very high likelihood, irrespective of what the final numbers look like. And hence, there will be policy consistency in terms of encouraging infrastructure investments. Within that, I mean, one will obviously have to pick and choose individual names basis what individual companies are performing and what the valuations are. Because remember, a number of these stocks have also moved up a lot in the last few years, and valuations do become a consideration at some point of time.
Dhiraj, the other stock I think we had discussed in the past was Zomato, and you were in quite early. The stock is almost at $200 now, and various brokerage reports now we see it, on a weekly basis, getting increasingly optimistic about prospects. What's your view?
I don't think I ever do an interview on CNBC without discussing Zomato. So yeah, it's I think a favorite thing we discuss every time. I think there's a very long runway of growth for Zomato, and now even their grocery business, Blinkit, is showing signs of strength and life, and hence, the run-up has been very strong. So can one rule out a bit of consolidation? Of course not. But this is something which over the next 5-7 years will continue to deliver absolutely superior and outstanding growth. So these are habit-changing businesses, and at one point of time it appeared like there would be a very, very tough competition. Everybody wanted to get into that space. Looks like it's now by and large becoming a duopoly, which is obviously fantastic for margins and obtaining a certain level of ROE, ROC longer term. So that consolidation is obviously helping. Business case was always there.
Okay, I wanted your thoughts also on the real estate space, because we're noticing a big trend, which is, a lot of redevelopment projects which are coming on board. Oberoi this morning has got that redevelopment project in Worli. And there is a lot of scope for many of these names. As we speak, Godrej Properties is at a fresh high. Brigade Enterprises at a fresh 52-week high. Do you see more merit in an upside for many of these real estate stocks?
I think the trend is very strong in real estate. There is demand. Earlier, there was demand largely and mostly in the premium segments. Now we are seeing demand a little bit in the upper segment as well. The lower part of the segment is still a little weak, but there is good demand in real estate across the board, which one can see in extremely strong pre-sales numbers almost every real estate company has been reporting. So the sector is on a strong wicket. I think there are a few more years of uptrend out there.
Well, Dhiraj, final question then before we let you go. What about the cement pack? The cement pack, in the near term, there is pricing pressure. But the street will be quite optimistic about prospects in second half of this year. First half will be marred by monsoon as well as by elections. Any view out there?
So cement, I've got a slightly different view from, especially if we talk from a stock price perspective. So in the early part of whole optimism on infrastructure and real estate, many investors prefer to play through cement rather than the actual infrastructure or real estate companies, saying we are not sure of many of these companies, many of the balance sheets, whether the revival is real or not. Cement looks like relatively safe. Most companies are either low leverage or net cash and a certain amount of downside protection. But now people are actually moving towards buying the primaries rather than the secondaries, and that's how I call them. So actually real estate companies, infrastructure companies, capex-driven companies, etc. And hence it's possible that the entire sort of infrastructure real estate growth could have been priced into cement a little bit earlier as compared to the other sectors, and cement has now become more of a narrower trading range kind of a sector. And as you rightly said, the supply issues are always there at cement. So capacity additions and hence the commodity price moving up or down, causing volatility is always there.
Okay, all right. Thanks a lot, Dhiraj, for joining in and filling us in with your thoughts on the markets and all those stocks as well that we did discuss.